So Daniel Kahneman won a Nobel Prize for his analysis on the inner workings of the human brain. And we often find that it's the field of psychology and not finance that is most helpful in achieving the long-term financial objectives for our clients. Researchers found that human beings tend to suffer the pain of a loss almost double than the pleasure of an equal gain. And our human brain, with its emotional and cognitive biases, often leads us to poor financial decision-making. Although black swan events such as the shutting down of the global economy due to COVID-19 have very undesirable consequences, of course, the reality is that the markets have recovered each time. To quote Sir John Templeton, the 4 most expensive words in history are, "This time, it's different." In the global financial crisis, the markets fell. The S&P 500 fell by 56%. It took about 9 months. The S&P 500 took 2.8 years to recover. In Black Monday, 1987, the markets fell by 28%. The S&P took just over a year to recover. In this COVID-19 crisis, the markets fell the fastest they ever had in history. They fell by 37% in just over 6 weeks. We are now almost back to where we started. And that this crisis is not over. I do think that the road ahead is going to be bumpy, but we will recover. So despite these reassuring statistics, frankly, I've been witness during this last crisis to things I'd never thought I'd see before. Wealthy people fighting over toilet paper. People are also hoarding the most amount of cash under their mattresses since Y2K. So at the beginning of the century, just before the beginning of the century, people went to the ATMs, withdrew money and stored it under their mattresses, and we are seeing the same levels of cash, almost as Y2K, being stored under mattresses. One has to ask the question, why do we human beings actually behave so irrationally? So this behavior can actually be explained by going back thousands of years. We have a very old brain. In fact, our brain is thought to be about 200,000 years old. Financial markets, however, have only been around for about 400 years. And it seems that we go back to very ancient and embedded patterns when making financial decisions. Research has shown that we actually use the same parts of the brain for processing decisions about financial risk-taking that we did in the past to avoid attack from predators. Our brains are wired for fight or flight. Over thousands of years, the evolution of Homo sapiens has favored those with the wherewithal to attack opportunity and flee from danger. However, financial markets require patience and investing over the long term. This irrational behavior is expensive. Mayer Statman, one of the leading behavioral scientists, actually showed that the heaviest traders lose about 4% of their account value each year due to poor timing and trading costs. A further study by Vanguard shows that over a 10-year period, impulsive behavior spanning the financial crisis actually cost investors about 2.5% each year. So as markets rise, investors feel secure and calm and they're inclined to invest more. And as they start falling, people become worried. They're worried that markets are going to continue to fall, so they actually hold back from investing. As markets advanced, at the beginning of the century, US investors actually placed about $660 billion of new money into equity mutual funds. During and after the crash, they actually withdrew about $500 billion, which actually was one of the best buying opportunities in history. The Tale of Two Investors shows two investors who invested $1,000 just at the peak before the financial crisis. Sharon acts emotionally. She withdraws her money at the bottom of the market and only reinvests again when the markets have recovered. After 7 years, she's only left with $531. Barbara, on the other hand, acts rationally. She stays the course, and after 7 years, she's left with $1,232. That's a substantial difference of $701. There's an abundance of statistics which actually prove the behavioral gap. And there is much research to show that clients who work with wealth managers or sophisticated financial physicians have far better outcomes. Our role is increasingly to advise our clients that their behavior may be ill-advised and to encourage them to stay the course. Statistically, 70% of wealth is lost over 2 generations and 90% over 3. The main reason for this is actually not having a financial plan as prescribed by a good financial physician. This plan should aim to keep the family's wealth invested over time in the correct mix of inflation-beating assets that meet the family's goals or aspirations. So a second reason for this loss is actually a lack of proper structuring and estate planning. And this is where a good financial physician should at least have a basic understanding of the underlying mechanics of structuring to know when to refer to an expert. Our clients are increasingly becoming more global, and their children often end up living in different countries. This can create very complex tax situations for trusts that were initially set up with all the beneficiaries actually living in their birth country. In addition, death, divorce, first, second, or multiple marriages can further complicate matters, and it's imperative that proper structuring is in place to ensure a smooth transition of assets. Within Investec Wealth and Investment, we often refer clients to our in-house tax and fiduciary team, who then can assist our clients with their estate and legacy planning. Given people's current fear of death and the importance of making sure that the assets are transitioned correctly, right now there's great demand for their services. And in times such as these, the team's capacity will continue to be pressed, especially in light of the increased rates of death, divorce, and all the lockdown babies that are going to be coming our way in the next 9 months. So as custodian of our clients' hard-earned assets, we seek to ensure that the assets are placed in the right mix of asset classes and that they're structured in the correct way so that in the end, their money and their investments grow. Hopefully then a modern family would have achieved most of their goals, which their money will have funded. A good home, well-educated children, the opportunity to potentially travel, and the ability to retire comfortably and with dignity.